Banks are raising fixed mortgage interest rates despite the RBA not lifting interest rates in November. Is this going to put Aussies in a world of hurt? Or are the banks justified in increasing their fixed interest rates from the 1, the 3, the 5-year fixed interest rate markets? Let's take a look. Even though the RBA hasn't lifted the official interest rate yet, banks are raising their fixed mortgage rates. The banks are getting a sniff and they sense the rate rise is on the horizon. Every property commentator and economic forecaster out there is talking about interest rate hikes potentially happening in 2023, even though the RBA has been steadfast in saying that they won't increase interest rates until 2024 to allow inflation to occur in the Australian market. So it's going to be interesting to see how this plays out in reality. I know that Westpac and CBA have increased their fixed interest rates in the 3 and the 5-year markets. And Emily and I thankfully just snuck in fixing our interest rate on a slightly lower rate with one of those big 4 banks, rather than the increased rate that's gone up 0.2% over the next 2 years that we fixed our property loans for. Now, ANZ Bank expects fixed interest rates to rise substantially in the next few months, said senior economist Felicity Emmett in a note to clients this week. This will cause house prices to rise more slowly, she said. The lowest mortgage rate available to new borrowers had already lifted from the historic lows seen earlier this year and is likely to rise substantially in the coming months, which will lower borrowing capacity and slow house price gain. Now, that's what we're going to see hopefully in reality. I don't want to see the market continue in such a heated fashion that things get out of control. I think it is important for the market to slow down a little bit because we've seen some great growth. Now, these fixed rate increases coupled with the debt to income ratio changes to cap people around the 6 times multiple are also going to slow the market over the next few months, but it won't necessarily stifle growth completely. This is in line with what a lot of people have been saying, that the market across Australia is expected to see 5 to 10% growth in 2022, and I'm still expecting that personally. There's definitely a lot of heat still in the market, and even if people only see, say, 30 to 50,000 reduction in their borrowing capacity, they're still going to go out there and there's still going to be a lot of demand for buying an investment property. This graph shows fixed mortgage interest rates compared to swap rates, a type of interest rate that depends on future interest rates. As you can see, the fixed interest rate usually follows the swap rates. And now the swap rates have shot up, we can expect fixed interest rates to rise. But only for new loans. The rates on loans that have already been made are set. That's why they call them fixed. Now, Australia has historically been a nation in love with the variable rate mortgage. But in the last few years, the fixed rate mortgage has become seriously popular. It was by far the cheapest rate you could get, and Aussies borrowed loads on it. In fact, almost half of all new mortgages are on fixed rates. That means that a rate rise in fixed interest rates really matters. Now, the reason over the last 10 to 15 years that Aussies have preferred variable rates is because over the long term, you've fared better when you've gone with a variable rate than you have with a fixed rate, because interest rates continue to fall over the last 15 years. But now we're in a low interest rate environment, they've really seen fixed rates take over because you've been able to get, say, 2% or 2.5% for a property purchase as a principal place of residence compared to, say, a 3% variable rate. So it does depend on the loan type that you're looking to use, but in the last 12 to 18 months, we've definitely seen a swing both in our own portfolio and through investors that we've been working with towards a preference for fixed rates over, say, a 2 to 3 year period compared to paying a slightly higher rate for a variable loan. The only thing I will caveat that is be careful when you're fixing rates, because obviously you can end up with break fees and it might not allow you to refinance to make another investment purchase without paying the break costs. And the break costs can be very significant depending on which institution you go with. So definitely keep that in mind if you're looking to manufacture value and refinance your property portfolio regularly, that variable rates tend to be a better play than fixed rates if you're looking to, take that into account. Now, higher interest rates should stop house prices rising so fast, which is a relief given that CoreLogic data shows they've risen over 21% in the last year. We've definitely seen that on the ground here in Brisbane. Suburbs you could buy for $500,000 are now $600,000. Some houses that were $700,000 or $800,000 are now selling well over the $1 million mark. definitely depends on the location, and not everywhere has risen a flat 20% equally. Some areas have gone up 35%, some have only gone up 15%, and there's opportunities still out there in the Brisbane market. I'm definitely bullish on Brisbane, as that's where we run our buyers agency, and Emily and I have put our money where our mouth is in investing here in the Brisbane market. So although we don't expect these unprecedented rises in the coming years, we definitely still see some growth in the Brisbane market over the short, mid and long term. Of course, higher interest rates do not make buying a house any cheaper. They actually increase the repayments. When you borrow $500,000 at a 2% on a 30-year loan, your lifetime interest repayments are $165,000. But if rates rise to 3%, your lifetime interest repayments would be $260,000. Well, that makes sense. If you had a 2% loan, it'd be cheaper, and a 3% loan, you pay more. The truth is that in a lifetime of a 30-year loan, rates could rise much more than 3%. Fixed interest rates could hit the 3% mark as soon as late this year and even keep rising. Now, I don't think that is an incorrect assessment. I think that's probably spot on. I don't expect interest rates to sit around the 2 to 3% mark over the long term. I can see them increasing from 2 to 3 to 4 to 5 over the coming years. And that's where having a cash flow portfolio that looks after itself and puts money back in your pocket is going to help you have that sleep at night factor. It's going to help you be comfortable with the growth in your property portfolio and not be over leveraged and unable to make your repayments back to your bank if interest rates rise over time, as we expect they will. So make sure you run your calculations with buffers in place and you have an emergency buffer to help you ride out that storm, and be comfortable with the repayments rather than at a 3% rate, at a 5% rate. And park that extra money in your offset account rather than paying down the loan directly. Interest rates are rising, fixed interest rates are being increased by the banks, but the market isn't significantly changing. They're only increasing the rates a little bit at the moment, and there's still a lot of cheap money out there. If the rates are going from 2.5% to 3%, it's still very affordable for a lot of people, and lots of properties up here in Brisbane are paying 4 to 5% yields, which allow people to hold those properties easily. Now, cheap money is going to not stick around forever, but the people that are able to access that money and buy assets are going to be at an advantage to the people that are unable to buy assets and get into the property market. We're going to end up seeing a two-horse race here between the people that have and the people that don't have, unfortunately. So those that have access to this cheap money and can refinance their portfolios and invest are going to be in a great place. And those people that are struggling to break into the property market are going to continue to have to sacrifice, save, maybe live in a share house, maybe live with their parents for a longer period of time just to break into the property market. Now that's where I see investing first rather than buying for yourself in a principal place of residence could be an advantage. Using the rent vesting strategy is going to help you invest. So it will be interesting to see how the property market continues over the next 12 to 18 months. And we're definitely going to keep an eye on interest rates, because as interest rates rise, we definitely expect to see a slowdown in property price growth. So make sure you subscribe to the channel if you want to keep up to date on the property market and have more videos on real estate, renovating and financial freedom come through in your YouTube feed. Like, subscribe, and I'll see you in the next one. Peace. And cheap money is what has fueled this property price boom over the last 12 months. Monks? Last 12 months? This is going to be that's going to be what you put at the end of the video. The last 12 monks have said their piece and they're not buying any property. I think this needs to be my last video for today. 12 monks, that's unbelievable. That is unbelievable. Let me finish this video, man. Holy moly. Okay.